Section 18 of the IGST Act, Input Tax Credit Utilization. Section 18 of the IGST Act addresses the transfer of input tax credit, ITC, for various tax payments. Here's a summary of its provisions. Utilization of credit. The section addresses scenarios where a taxable person uses the credit of integrated tax for the payment of central tax, union territory tax, state tax, reduction of integrated tax. When a taxpayer utilizes an integrated tax credit for central tax payment, the amount collected as integrated tax is reduced by the equivalent amount of credit utilized. This reduction applies similarly when the credit is used for union territory tax and state tax, although the recipients of the transferred funds differ. Transfer of funds. For central tax, the central government is obliged to transfer an amount equal to the credit utilized from the integrated tax account to the central tax account. This transfer must occur in a manner and timeframe as prescribed by regulations under the Act. For union territory tax, similarly, when the credit is utilized for union territory tax, the central government will transfer the corresponding amount from the integrated tax account to the union territory tax account in a prescribed manner and timeline. For state tax, in the case of state tax, the amount collected as integrated tax must likewise be reduced, with the appropriate amount being allocated to the respective state government. The central government will then transfer this apportioned amount to the state's account within the prescribed framework. Definition of appropriate state. This term refers to the state or union territory where a taxpayer is registered or must register under the Central Goods and Services Tax (IGST) Act. In conclusion, Section 18 ensures that integrated tax credit usage for various tax payments transfers amounts between government accounts, maintaining the flow of tax credits and funds across central, state, and union territory tax systems.